So, a very warm welcome to you all. Thank you so much for joining us live now, you guys. And for those watching the recording, a very warm welcome to you as well. So, today, Emma Bale, the wondrous Emma, will be taking us through all the important things to help you get a better handle on your finances as a small business, property owner, or sole trader. So I don't know if all of you know, but as part of Evolve Accounting's vision, mission, and values, our focus is to make tax and accounting really easy to understand for everybody. It's a family-run business, and we appreciate that finances can be really confusing. So this is a very safe space for you guys today. Please feel free to ask any questions or share any worries you have. I am joining you as not just a host, but also a small business owner who doesn't really do finances very well. Although Emma is my accountant and is incredible, it's the day-to-day stuff that I'm not good at. So I may be asking questions that hopefully you guys will have in your mind as well. So as we go through the session, I'll keep you on mute. But as I said, drop your questions in the chat if you'd be more comfortable, and I'll pick an appropriate time to ask Emma the right questions. But there will also be a chance at the end to have a bit of a discussion. We will try to keep the session as informal as possible. We like to have a bit of a laugh, don't we, Emma? And
We
let's
do.
make making tax easy peasy, but also fun.
So fun. It has to be fun.
It does. So Emma's going to be showing you some live examples on the screen to help you understand the processes that we're going to be going through. Please feel free to use your settings on Zoom to make the screen larger or smaller. Any problems, give me a shout and I can help you to navigate how that looks. But with anything, just please let me know if there's any problems by direct message and I'll do my very best to help. You are all in a safe space today. We're here to help. So Emma, let's start. Thank you for taking us through this today.
Thank you so much, Lynette. And thank you for setting this up. I think if you've attended any of our webinars before, you'll know that I very heavily rely on Lynette for the tech side of it to make sure all of this happens and it's seamless. So yeah, if you do have any problems, just direct your questions to Lynette. So, first of all, for those of you, I've got a good mix here of some of our existing clients. I recognise some names there, and also some new people. So, just a quick background as to who we are. So, we are. My name is Emma, and my husband and I, Simon, we run together Evolve Accounting. I've been an accountant for over 25 years, which gives you a slight idea of how old I am. But this business has been going for just over 10 years. We actually celebrated our 10th business anniversary in October last year. And we very much, this business is all about the small businesses. So it's small businesses like ours. I grew up, my dad ran a small business. So I grew up in that small business environment. We run a small business and we love supporting small businesses. So everything we do really, and all these extra bits that we do, including these webinars, is to try and find additional ways that we can support small businesses. It's not just about giving you a tax number at the end of the year, it's also about helping you to understand your business. So with that said, the key documents that you have available to you to understand your business is the P&L, the profit and loss account, and the balance sheet. These are produced for you by your accountant once a year as a minimum. So if you are a limited company, your accountant will be producing for you a set of accounts with a profit and loss account and a balance sheet. And you legally have to have those produced and to a particular format, because they are then sent to Companies House and HMRC. If you're a sole trader, you don't have a legal obligation to provide these documents, but certainly your accountant will need to produce your profit and loss account in order to produce your tax return. But also these documents are really important for you to understanding your business as well. So what I'm going to do is I have created some accounts for a fictitious company, profit and loss and a balance sheet. And today I'm going to talk you through what each of those documents are. I'm just going to share my screen. Now, well, I've lost my spreadsheet now. Here we go. Okay. So I'm going to be looking at three key questions here. What are they? What is a profit and loss account? What is a balance sheet? And I'm going to talk you through each of those documents, going through the key component parts. Why do you have them? And I think we've already sort of answered that. Partly it's compliance, partly, depending on your business, you need it to satisfy Companies House and HMRC, but also you have that you have these as a business owner, so that you can understand your business and what can you do with them. And this is where it gets really fun, and I get all geeky and nerdy as an accountant, because these documents, there's so much you can do with the information that's in these documents, to understand and analyze your business, to help you make decisions about your business, whether it's short-term cash flow decisions or longer-term strategic decisions. So I'm hoping to cover all of those things today. I'm going to plow straight in, and we're going to look at a profit and loss account. So I've done these on a spreadsheet because some people are using, did you want to come? My husband was just about to walk in. Some of you are using a spreadsheet to keep your records, and some of you will be using bookkeeping software such as Xero, FreeAgent, or QuickBooks. So I don't want to confuse by, if I look at one particular software and you're not using that one, it might confuse the issue. So I've just done it on a spreadsheet. So this is a generic profit and loss account. If we've got time at the end, I'm going to have a quick show and have a quick look at Xero for you. So the fictitious company I've come up with is a wooden toy manufacturer. And the reason I've gone for that is because this type of business will have physical materials as well, wood, nails, etc., that they're going to purchase to produce their product. Whereas a more service-based business, you're not going to be buying physical materials to produce a project, but you will have lots of overheads. So this P&L will sort of cover pretty much all of the things that as a business you might have no matter what you do. So I'm going to talk you through. So at the top, the very top, you are always going to see your sales. Another word for this is turnover. And almost always this is the income that you receive from your customers. Occasionally there might be some other income there. So perhaps if you're a business where you receive grant income from the government or grant income from different places. But on the whole, if you're a normal trading company, this is your sales or your income. And we always see that at the top. The next section down is we look at the cost of sales. So these are the costs that you incur in producing your sales. So again, for the wooden toy company, that's going to be their wood, their screws, glue, paint, maybe things like that, the physical things that are used to produce their product. And I've also put in direct labour. Now there's a difference between direct labour and overhead labour. Direct labour is the wages or the salaries that you're paying for the people on the factory floor with their tools who are physically making the products. And all of that information brings us to our gross profit. So it's our sales less our cost of sales. So that the cost of the items that allow you to make the sale is the gross profit. So the way to think about that is, the idea is if all your sales disappeared, then also your cost of sales would disappear and you'd have a zero gross profit. So really what should happen is if your sales increase or decrease, your cost of sales would increase and decrease. Whereas further down the P&L, we're going to have a look and we're going to look at overheads. When we're looking at overheads, those things are going to stay the same all the time. So that's why it's really helpful to split it out and look at your gross profit, because it tells you quite a lot about your business actually. And one of the lovely things that we can do, a very quick calculation here, is to look at our gross profit margin. And we do that literally by dividing the gross profit, which is sales less costs, gives you gross profit, and dividing that by sales, and it gives you a percentage. I'm going to come back to what we can do with that percentage later, but it's really just getting a feel that the top half of your P&L is giving you a picture of just your gross profit and what it costs you to deliver your service or to deliver your product. We then slide further down the P&L and we're looking at our overheads. So the idea with your overheads is, as a business, regardless of whether your sales go up or down, regardless as your gross profit goes up and down, your overheads are going to remain the same. So if we look at a really good example here, we've got rent. So this business is a toy manufacturer. They rent a small premises to make their toys. Their rent is going to be the same. So even if they have a terrible year and they hardly sell any toys, they're still going to have rent of £9,500. Or they can have an amazing year and sell loads of toys, but their rent's still going to be £9,500. And that's broadly the same for all of these overheads here. So all of these costs that we put under overheads are not directly related to generating that sale or producing that product or service. And that's a really helpful way of splitting this out so that you can really understand your business and the different cost drivers associated with it. And then this takes us to the very bottom, which is your profit or your loss. So what that document is doing is taking your sales, less your cost of sales, less all of your overheads, and then working out, is there a surplus or not? So if your costs are less than your sales, you've made a profit. If your costs are greater than your sales, then you've made a loss. And on the whole, if when your accountant produces your P&L, if that bottom figure is in brackets, that's telling you that it's a loss. And if it's a positive number, then it's a profit. So key thing to remember with all of this, and I put it in a big yellow box here, is there are two ways of producing these figures, which is accrual basis and cash basis. The first thing I'd say is you'll struggle to find an accountant that will produce accounts on the cash basis, but it's legal to do so for sole traders. So cash is literally money in, money out. So if you are a sole trader and you're doing your own accounts, you might choose to use the cash basis. So your sales will be based on the money coming in, and your costs will be when you pay the expenses. On the whole, though, if you've had an accountant doing this, you're going to be working on the accruals basis. And it's really important to understand this, that these figures are not when the money comes in and when the money goes out. It's when the sale occurred and when the cost occurred. So if we think about our toy manufacturer here, I've put the year end as the end of December for this particular business. So let's say that right at the end of December, they sold some toys to a toy shop. The sale took place, the invoice was sent, and so the invoice, that sale, is reflected in the P&L. But let's say that the customer took 6 weeks to pay, didn't pay until February. That sale is still reflected in this P&L. It doesn't matter that the invoice hasn't been paid yet. The sale took place in this period, in the year ending December 2024. And we can talk a minute about where this unpaid invoice sits. But it's the same with our costs. So we are thinking about not whether or not we physically paid for the materials, it's whether we've received those materials and used those materials to make that sale, to produce that product. And we can go down onto the overheads and see more examples of that. Your accountancy fee is a really good example of this. So if you think your accountant does the accounts for this year, for the year ending the 31st of December, but your accountant might do them 2, 3, 4, 5, 6 weeks later. But the accountant's fee relates to this period. So we'll put the accountant fee in that period, even though you haven't even received an invoice for it yet, because that cost relates to this period of time. And that's a really important concept, actually, and it really helps to, and this is why all accountants use the accruals basis, it really helps to understand your business and because we're matching to the right time period when the sale occurred and when the cost, and so you're not getting a mismatch in time periods. The profit at the bottom will go towards generating your tax calculation. However, there will be some adjustments. I'm going to talk about that a little bit later. But effectively what we're doing is, as well as understanding our business in terms of sales and costs, we're also understanding the profit or loss that we might use to generate a tax calculation. That's your profit and loss account. Balance sheet. Now, this is the second of the two documents that you will receive as part of your year-end accounts. Balance sheet is doing something completely or very different from your profit and loss account. The profit and loss account we looked at is telling you how much profit, what happened in that time period. So in the year ending the 31st of December. What your balance sheet's doing, it's actually giving a snapshot of what your business looked like on the 31st of December. So literally the next day this will change. And it's looking at, it's a sum up of effectively the net worth of your business, and it's split into categories. So at the top, we have fixed assets. So this is physical things that the business owns long term. So this isn't things like materials that you've or stock that you've bought for resale or anything like that. This is things like your computer you have in your office. This is plant and machinery. So for this wooden toy manufacturer, they have some factory equipment that they use and tools that they use to produce their toys. So that sits on the balance sheet. And also vehicles. So this particular business has a van that they use to deliver their product. Once they've finished making their toys, they're delivered to their suppliers. And all of those items sit on the balance sheet. And we start off at cost, so we put it on the cost to the business. And then each year we depreciate. So each year we will reduce the value of these on the balance sheet by a percentage. And we will put that percentage amount, the amount that we're reducing it, it's called depreciation, we will put that to the P&L. And so this is where we start to see how the balance sheet and the P&L interact with each other. So I'm just going to pop back to the P&L. When we look down here, we can see depreciation. So in this example, what's happened is this business has bought a van, and we've depreciated in the first year the van by 25%. We've reduced the vehicle on the balance sheet by 25% to reflect that over time that vehicle is lowering in value. And then we put that cost to the P&L. And what that allows us to do is spread that cost in our accounts over the life of that vehicle. Because if you think about it, if you have your profit and loss account, you buy a van for like 20 grand. If you put the whole 20 grand in your cost, it's going to make it look like your business potentially lost money that year or had a massive cost, when it didn't, because you're going to have that van, 5, 10, maybe years. So we spread that cost over. So we're seeing that reduction in value in the fixed assets on the balance sheet. And then obviously if you sell one of these assets, that gets taken off the balance sheet. So the next bit we've got here is the current assets. Current assets are anything that can be converted to cash within a year. So the really obvious one is the money in your bank. You can convert that to cash really quickly. You just stick your card in your machine, you get that money out. Also physical cash. So for this business, I've just put 100 quid. And that more often than not is a petty cash tin in the office desk somewhere, to buy tea and sugar for the office or bits of stationery. And I would say, just as a side note, HMRC don't like cash businesses. It makes them really nervous. So, don't have any more cash in there than you need to. But for some businesses, if this was a pub, for example, we would see that cash number be a lot higher because there'd be cash in the till, there'd be cash in the safe, and that's how that works. Next one down, we have debtors or receivables. So these are invoices that we've sent to our customers, but we have not yet received the money for. So if we go back and think about the P&L for a few minutes, I'm just going to pop back. And again, this is how our P&L and our balance sheet interact with each other. So we talked about how these sales is on a accruals basis. So we've made a sale, we've raised an invoice, we've sent the invoice to the customer. So that sale is showing in that P&L in sales, but the customer hasn't paid it yet. So that's where we're seeing the other side of that. We're seeing that here on your balance sheet. So for this particular business, on the 31st of December, there was £10,000 worth of invoices that they had sent out to their customers but hadn't yet paid, but they're expecting to be paid. It's not a bad debt, it just hasn't been paid. And that's again why that's included in current assets, because we expect to have that money soon. We just don't have it at the moment. Stock is another similar item. So again, thinking about the matching or accruals process that we talked about with our P&L, we're only going to reflect in our profit and loss account the materials that we used to produce our toys. So at the end of the year, we might have a big pile of wood and screws and nails and paint and all the things that we use to make our wooden toys. So we'll put that, instead of having that cost in the P&L and skewing those figures, we'll have that cost on the balance sheet because we're going to use those materials in the future. But at the moment, it's stock. And it depends what business you have. Again, if you're a pub, that would be all your unsold bottles of wine and beer. If you are a hairdresser's, that might be all your unsold bottles or unused bottles of shampoos. So stocks a really important figure actually on your balance sheet because it shows it's an asset. It's something you've bought. You haven't yet used it yet, but you're going to. And in theory, you could sell that and get the money back for that. So that's why it's a current asset. Final one I've put on here is deposit on premises. So this business rents a small factory space. When they took that business on, when they rented that factory, the landlord asked for a deposit of £500. That sits on the balance sheet because we know that while we've paid that £500 out, it's not really a cost because at some point we're going to get that back, in theory, if we don't trash the factory or do anything awful, but that's our money to come back. So that again sits on that balance sheet as a current asset. And then we total these all up so we can then see a total of each type of asset that we have. Next one down is current liabilities. So it works on the same basis, but the other way around. So this is anything that we know we've got to pay out, but again, in the short term, within the next year. So the first one is accruals. So if we go back and we think about our profit and loss account, and I use the accountancy cost as an example, your accountant hadn't even sent you the invoice on the 31st of December. So that invoice can't sit as an unpaid invoice because you haven't even received it. But that work did relate to this time period. So we do an accrual. We put the cost in the P&L, and then we put the money that you know you are going to have to pay on the balance sheet as an accrual. But you haven't received the invoice yet. So it's just, we know that we're going to have to pay this money, and it relates to that period of time. Creditors and payables. So it's very similar to accruals, but with these, we've actually received the invoices. So we've bought some materials, maybe that's our paint or our wood for our wooden toys. The invoice is in the P&L as a cost, but we haven't made that payment to the supplier. Maybe we've got really great credit terms and we don't have to pay it for 2 months. So it's sat there as we know we're going to have to pay it. We haven't done it yet. Director loan only really applies if you have a limited company. So you're the director of a limited company. And this is if, as a director, you've loaned your business some money. So it might be some startup costs. It might simply be, I'm prone to this, I'll be in Tesco's, I need to buy some stationery, I've forgotten to take my business card with me, I'll buy it myself, put it through the director loan, and the business owes me that money back. Corporation tax liability, again, this is if you're a limited company, that's the tax that's been calculated for that year, but you've got time to pay that. So you know you're going to have to pay it, but you haven't done yet. That's exactly the same thing. The VAT's in, you know, you've charged the VAT, you've incurred the VAT, you know, you're going to need to pay that maybe next month. And credit card. So company credit card, again, that's a debt, and you know, you're going to have to pay in the short term. There's all sorts of other types of current liabilities. That's the main ones you're ever going to see on a balance sheet for a small business, really. But we add all of that up and we can see this business, it's got 16 grand that in the fairly short term, it is going to have to pay out. And that's a really important thing to know as a business owner, isn't it? So that you can manage your cash flow and you know how much has got to go out. Net current assets. So what we do is we take one off the other. So we've got our fixed assets, our current assets, less our current liabilities. And that gives us a figure, in this instance, 32 grand. And that's lovely. It's a nice positive figure. So what it means is if everything went wrong and we had to, you know, pay all of our credit or current liabilities quickly, we've got enough current assets to pay it back. We've got enough money in the bank, we've got enough money coming through from customers when they pay their invoices, we're covered. Except that with this business, we've also got a long-term liability, and we split that out separately so that we can understand what's got to be paid quickly and what's got to be paid in the long term. And this business has got a long-term loan. It could be a startup loan. There's a lot of people at the moment with bounce back loans on their balance sheets from COVID. And all of a sudden then this business starts to look a little bit unhealthy, because when we take off what it owes long term, our net assets are in a negative. So that means that our fixed assets and our current assets, all the positive stuff we've got, the things we own, the money in the bank, the cash, the money that our customers are going to pay to us at some point, is not enough to pay all of our liabilities, our short-term and long-term liabilities. So we have a negative. And actually, this is what we've got in this yellow circle. Is this business solvent? And I think this is a really important question for business owners to ask themselves, is my business solvent? If you've got a negative, if your liabilities, the money or the things that you owe out is higher, it's a bigger number than your assets, the good stuff that you've got, you're in a negative position, so your business is insolvent. And I'll come back to this in a minute. Just at the bottom here, and I don't want to dwell on this too much because I'm not sure how useful it is for small business owners. Balance sheets, they balance. That's why they're called a balance sheet, and it's all to do with the double entry bookkeeping. So you will always find on your balance sheet the same number twice. Here, which is the sum of your fixed current and assets and your liabilities, but it will always be the same as this number. That's partly, if those numbers are the same, we know it's done correctly. Software doesn't allow you to have an unbalanced balance sheet, but I remember back in the days of having to do these things at uni, and your balance sheet wouldn't balance. You'd have to try and figure out where it had gone wrong. But your bottom bit is really just your share capital, retained profits from previous years, current year profits, and if you're a limited company, the dividends that you've taken out. Now, if we go back to think about, ask the question, is this business solvent? Quite for a limited company, if you own a small limited company, quite often the reason that your business is insolvent is because the business owner has taken too many dividends out. So if we look at this bottom figure here, if I take that 30 grand out, all of a sudden that's not insolvent anymore, right? Or if they'd just taken fewer dividends out, so instead of the 30 grand, if they'd taken 20,000, it would no longer be an insolvent business. So we see quite a lot of power with this balance sheet, don't we? It explains to us how we understand the value of our assets, how we understand the value of everything that's owed to us, how we understand the value of short-term, the money, that the cash flow that we need. And also it helps us to make decisions as business owners, such as what do we take out in dividends in order to make sure that our business is solvent. And even if you're not a limited company, even if you're a sole trader, that, you know, replace dividends with drawings and you've got the same thing. If you take your drawings out and you go and spend it on, you know, nights out or mortgages or kids or whatever it is, and you don't leave enough money in your bank to pay your liabilities, your tax, your creditors, etc., you're in the same position. So this balance sheet tells a real story about this financial health. Where it becomes particularly important, as well as managing your business, is when you come into times when you want to take a loan out. So if you're a owner director of a small limited company, and it's time for you to buy your dream home or remortgage or whatever it is, your mortgage lender will quite often ask to see your balance sheet. And if it's insolvent, quite often they won't lend to you. Equally, if you require finance for your business, like, you know, a business loan or whatever it is, if you've got an insolvent balance sheet and an insolvent business, you're going to have difficulty getting anybody to lend you money. So understanding the health of your business and your balance sheet actually then becomes really important from a finance point of view. Is that, I've covered that, like the P&L and balance sheet, and I feel like I've talked a lot. Lynette, does that all make sense to you? You're my check.
It does. And I'm actually sitting here on Free Agent as you speak, looking through mine, going, oh, okay, that's interesting.
Yeah, and this is the really good thing. If you do use a software like Free Agent or Xero or QuickBooks, you can run these reports. I'm hoping to have enough time at the end where I can show you on QuickBooks, but you can run these reports directly out of your software, which is, you know, at the touch of a button. So that's the power of these accounts, isn't it? They're freely available to all business owners.
So we've had a question from Estelle. So Estelle manually produces her invoices, so not within Xero. So her sales won't show on the Xero profit and loss account on the date invoiced, only once they're settled. And that's the same for payable invoices. So she said, is this okay, or am I going to prison?
You're not going to prison. No, you're not going to prison. So some people do that. Xero, without getting into a big sort of training thing on Xero, which I'm happy to sort of on another session have a look at this, but you can produce sales invoices in Xero. So you can set up a template within Xero, and then when you send an invoice to your client, you click, you know, create invoice and send it. And when you do that, the invoice is then in your P&L immediately. So that sort of solves that problem. A second way of doing it is some people have very bespoke invoices and they don't want to use the Xero template, and so they do it on a Word document. You can then just create a little dummy invoice within Xero so that you still got that information. If your customers are paying you very quickly, then, you know, maybe you send the invoice today and you know you're going to get it within a week, then from a reporting point of view, it's not going to make a huge difference anyway. But I think, you know, I'm a big fan of just using the invoicing facility in Xero or Free Agent or QuickBooks, because that's kind of proper accounting, and it's gonna put everything in for you. It's also going to give you visibility of your unpaid invoices as well, which you'll be able to see on your balance sheet.
Okay, we've just Jessica's just joined us. Jessica, we've just gone through the profit and loss account and balance sheet of a dummy company, but we are recording, so you won't miss out. You'll receive this recording in the follow-up email. So
brilliant. Hi, Jessica. So I'm going to just quickly, today isn't really about tax, but I did want to just touch on the idea that the accounting profits, the profit in your P&L, is quite often different than the profit that you'll see in your tax return. And this is a question we'll quite often get. You know, accountants will send the accounts and the tax return, and then the client will go back and ask the question, have we made an error? Because what they're seeing on the bottom of their P&L, so this figure, this profit, is quite often different than the profit in the tax calculation. So I just want to sort of bridge that gap so we understand that. So I've done a little make-believe tax calculation here. Again, I've assumed it's corporation tax because that's a bit simpler. So when we do a corporation tax calculation, but it's the same if you're a sole trader, it's just the tax is different, but the principle is the same. That's really important. So what we do is we start with the profit from the account. So you'll see, if I look at prior year, or if I look at current year, 25 grand, and then we look at the profit and loss, it's the same figure. So we do start with the figure in profit and loss. However, there are certain costs or ways of calculating things that aren't allowable. So I'm going to start with the really obvious one, is client entertaining. So if we look in our profit and loss account, this company, this business, has spent some money entertaining clients. And that's great. That's a valid, you know, a lot of us need to do business that way. We need to take our clients out, schmooze them, do lunches with key clients, all that sort of thing, send them gifts, and that's fine. And it's a legitimate business and expense, and you should absolutely have that in your P&L, because you want to, as a business owner, track how much you've spent on that legitimate business cost. However, HMRC do not allow it as an allowable business expense, so you don't get the tax deduction for it. So when we come to do your tax calculation, we add that figure back in to that starting figure. Same with depreciation. So we talked about when you have fixed assets, you buy a van or a bit of kit, you put it on your balance sheet, we depreciate it by a percentage every year, and you'll see that figure appearing in your profit and loss. And that's really important because that's smoothing that cost of that. You know, you bought a van, you're going to have it for 10 years, you have a percentage of that van cost in your P&L each of the 10 years. So it smooths that cost out. But HMRC do tax in a different way. So we also add back the depreciation. So those are two adjustments that we make straight off from your starting point in your accounts profit. Add back depreciation, add back the client entertainment. There's a few other more complicated bits as well, but those are the ones we see kind of all the time. Then what we do is we deduct lovely things that we can deduct, and our fixed assets are a really good example of that. So what we're saying with this example company is in the first year, so the prior year to what we're looking at, they bought computer equipment, plant and machinery, and vehicles. So instead of having the tax deduction for the percentage of that depreciation, we can have a tax deduction for the entire lot, for all of it. Or we can choose 18% capital allowances, or a sort of combination of the two. So that's when your accountant really starts doing their work for you, and they're working out how to get the best tax allowance that they can for you. But that means then, so looking at this one, our starting profit per the accounts was 34.5 grand. We added back the depreciation because that's just an accounting calculation. We added back the client entertainment because that's not allowable. But then we deduct our capital allowances for our purchases for the kit. That then brings us down to a taxable profit of just over 6 grand, which is actually quite a lot less than our profit that we had in our accounts. And then when we calculate the tax on that, and then you've got a lovely low corporation tax of just over £1,000. Whereas if you were paying 19% on that starting point, that would be, you know, an awful lot more. In the current year, of course, we see a slightly different picture. So we add back the depreciation again, we add back the client entertaining, but we haven't made any more purchases of plant and machinery. We've taken the tax benefit, all of that in the previous year. So we're not going to get that benefit quite so much. So therefore, our taxable profit is a bit more and our corporation tax is a bit higher. But that really bridges the gap there between what you're seeing in your accounts and what you're seeing in your tax calculation, and those adjustments that your accountant quite often has to make. I'm not going to dwell on that because taxes, we could do a whole session on tax, but that sort of explains the profit. Where I want to go now is look at the analysis and the information that you can pull from your accounts, because I think this is where it gets really interesting as a business owner and as an accountant. Actually, I love this side of it. So you've been sent this lovely P&L by your accountant. And it's not just as simple as, oh, that's how much I spent and that's how much profit I've made. We can really pull some information out of here. So for a start, quite often your accountant will include some extra information. So they'll quite often include a prior year comparator and then a variance column. And this is really good. This is really useful stuff, isn't it? Because it tells you, in the case of this business, last year, their sales was 150,000. And this year it's 170,000. So their sales have gone up by 25 grand. That's amazing. We're celebrating, right? An extra 25 grand. But then we go and look at our gross profit and it's lower. So our gross profit is actually lower this year by 5 grand. But how on earth can that be? Because we've sold more. We've sold an extra £25,000 worth of product, but somehow we've ended up with 5 grand less profit. And this is the power of your gross profit. So then we can start really interrogating this. We can start to look at it. And we can do some really basic percentages. So if we look at our gross profit percentage, so that's the gross profit divided by the sales. We do that for the current year and the previous year. We can see that our gross profit fell compared to last year. Last year it's 47. This year it's only 37. Well, what on earth is going on? So then we can have a look at materials as a percentage of sales for this year and last year, and labour. And we can see that those percentages are going up. So we're spending more. So something's happening here. Either, well, it looks like our cost of materials have gone up. But it looks like either we haven't increased our sales price to reflect the extra costs that we're incurring, or it looks like we have lost control of our spending. So we're buying extra materials, we're not negotiating good prices. So while our sales are going up, our costs are going up at a faster rate. So actually, we're not making the money that we're making. So that 25 grand of extra sales actually wasn't really worth doing because we've lost money on some of that. But when we start to analyse this out, we can really start to understand that. Same with the overheads, and it really basic percentages. You can just do a percentage of the cost as a percentage of the sale and compare it year on year. So with advertising, we can see that not only did it go up by £5,000, well, it's £5,000 this year, and it was £3,000 the year before, but actually as a percentage of sales, it goes up. So our advertising has proportionately increased more than the sales have gone. That could be a good thing, but is it? Are we, for the extra investment in our advertising, are we seeing that extra growth in sales? We could also look at admin salaries. We've given our admin staff a pay rise of 2 grand, but this is now 6% of sales as opposed to 5% of sales. Is that a good thing? Are we happy with that? Again, should we be putting our prices up to reflect this increase in cost that we're incurring? Because when we look right down to the bottom, we're seeing our margin has fallen. So in the previous year, our profit as a percentage of sales was 23%. This year, it's only 14%. So we start off looking at this document and going, yeah, haven't we done well? We've done an extra £25,000 worth of sales. That's brilliant. Aren't we epic? And then by the time we get down to the bottom of it, we go, oh, actually, we're worse off than we were by £9,000 because we've lost control of our costs and we're not thinking about them in the way that we should be, or not actively, thinking about how we're managing them. So it could be that we want our materials to go up. Maybe we have now started to buy much better quality materials, but we need that to be reflected in the sale cost. It might be that it's a great thing that our advertising is going up. We're really investing in that side of our business to bring in new sales. And it might be that we know that those extra sales aren't going to come in till the next year. But it's about looking at those figures and understanding what those figures mean so that we're making strategic decisions for our business. We can do similar analysis with our balance sheet. So again, when your accountant produces your balance sheet for you, there will be some comparators. So as well as your current year, you're going to have prior year and you're going to have a variance. And so again, we can look you know, has our fixed assets we'd expect to go down because the value of them will go down unless we purchase some more. But we can see here, we've got a lot less money in our bank than we did last year. Are we okay with that? Oh, our debtors have gone up. So these are to remind you, these are the sales invoices that we've sent to our customers that they haven't yet paid. Well, this time last year, we only had £3,000 that we hadn't been paid, and now we've got 10 grand. So what's going on there? Why have we got more invoices that haven't been paid to us? And likewise, we can look at our liabilities as well. You know, we'd expect our corporation tax to go up because the business, because we don't have the tax breaks that we talked about earlier. You know, is our director loan going up? You know, are we comfortable with our creditors that we're paying our suppliers and our long-term loan? So we can really use this document then to look at the progress of our business. And again, if we look at, is this business solvent? If we look at the first year, the previous year, we were solvent by 8 grand. This year, we're insolvent by just under 3 grand. So again, that's quite a powerful message. Something's gone on compared to the previous year with this business that's now pushed it into insolvency. But again, our starting point was looking at our P&L and saying, oh, look at all these extra sales, haven't we done well? But all of a sudden, actually, we've made less profit and our business is insolvent. So what on earth are we doing? So we can do further analysis. I'm just conscious of time here. We can do further analysis on this to delve even deeper into these accounts. I've done a little tab here. So I'll go back to P&L. So the first thing we could do is we can track, and especially if you are using software such as Xero, FreeAgent, QuickBooks, you can categorize your sales by the different types of sales. So what I've done for this business, I've kept it really simple. They're a wooden toy manufacturer. So this business has 2 products. They have yo-yos and they have spinning tops. So we can see from one year to the next, the yo-yo sales have remained flat and are increased in sales. It's all in the spinning tops. We're selling more spinning tops. So we can start to understand that. Let's have a look at our analysis. Okay, so let's analyze this out a bit better. Let's have a look at spinning tops sales and the materials and the labor that it costs to make those spinning tops. So again, we're just focusing on our gross profit here. We're not thinking about the overheads because we've got to pay our rent and our electricity and all of those things regardless. Let's just look at these products or these services. Spinning tops versus yo-yos. And very quickly, we start to see some real differences in gross profit margin. So if we can, again, to remind you, gross profit is the gross profit divided by the sales. And what we're seeing here, well, yo-yos are actually a lot less profitable, aren't they? Because what this figure here is saying, for spinning tops, for every £1 of sales we make 50 pence of profit. But for every yo-yo we sell, for every £1, we only get 20 pence back of profit. So now we're starting to see, actually, as a business, where we're making our money is spinning tops. So then we can make some real strategic decisions here. Do we stop selling yo-yos? Or do we increase the price of yo-yos? Or do we further advertise yo-yos and you know, increase the margin on that, improve the materials cost, increase the price, and then go back into our marketing then and really start advertising that? What do we want to do with this information? Because now we understand where our costs are going, where our money's coming from. And there are lots of other things you can do and to analyze. So I'll just click here. So you can analyze by customer. So you could do this exact same analysis, but instead of your products and your services, you could have all your customers, and you could look, and this will work particularly if you're a service industry, maybe. You could add extra information. How many hours do I spend on this particular client? You know, what is my margin on that? You can analyze by month. So if we go back to our P&L and we've got the full year in the prior year, you could have, and I love doing this for my business, you could have a column for every single month. And then you can start picking up trends. Is there times of the year that I'm less busy? What do I want to do about that? Is that where I want to target my marketing? Or is that where I want to book my holiday? You can really start thinking about the trends in your business. I somehow can't get, there we go. Year to date is really important. So I think a lot of business owners wait until their accountants produce their accounts at the end of the year, and then they look at what happened year to date. So if you're using Xero, QuickBooks Free Agent, you can run these reports as long as you're keeping up to date with your bookkeeping. You can run these reports really regularly, so you can see year to date, and you can compare actual to budget. So how many people here have I'm not going to shame you all, but how many people of you have a budget? A plan for the year, which you could upload, put it in your spreadsheet, put it into your software, and compare your performance year to date to your budget. So you can start looking at it and going, okay, I expected by this time of year, I thought I was going to have sold 70 grand's worth of spinning tops, and I haven't. I've only sold 50 grand's worth of spinning tops. What's gone wrong? What is it? Again, is it that I'm not pushing my advertising? Is it that I'm not pushing the sales in some way? Is customers not interested in spinning tops anymore? Should we be looking at introducing a new product or whatever it is? But that year to date and comparing it to a budget is a really powerful thing, actually. You can use this. Oh dear, this isn't working. I had a lovely graph here and it's gone. I don't know why. Imagine there's a pie chart there. So for some people are very visual. So it could be, I had a client like this a few years ago who, an amazing businessman, but didn't really understand or struggled to understand the figures. So I used to put everything in a graph. So you can take all this information and you can put it in these beautiful graphs. Maybe you're the real finance brain, but your business partner is a much more visual creative person. So it helps them to see their financial information in terms of a pie chart. And if this was working, you would see spinning tops versus yo-yos in a pie chart, so that you'd be able to see visually which one was selling more than the other. And the final thing I want to look at with what information you can pull from here is the ratios. So we've already looked at a couple of ratios already. So we looked at gross profit margin, and I keep banging this, but it's a really good one. So your gross profit margin is, I'm going to go back to it. It's your gross profit divided by your sales. And that's going to give you a percentage that you can then compare to other periods. Your net profit margin is the same, but it's just the net profit. So it's right at the bottom. But there's some other ones as well you can do. And I've just put a couple here, but I mean, if you have a Google, there's industry specific ratios that you can do with this information. But one that I really like is debtor days. So if we go back and have a look in our balance sheet, and you can see, we talked about this earlier, that your debtors, so this is, you have sent an invoice to a customer and they have not yet paid it. So we said at the end of the current year, per our balance sheet, there's £10,000 worth of debtors outstanding, £10,000 of sales invoices that you've not received the money for, compared to the previous year when it was only 3,000. So we can do a little ratio, and we basically just divide that number by sales and times it by 365 days in the year. And it gives us debtor days, current year and prior year. So what this is telling us is that last year, on average, our customers were paying their invoices within 7 days. But this year, on average, our customers are paying their invoices within 21 days. What is going on? We've got this lag now. So is it that we are losing control of our credit control? Are we forgetting to send our invoice reminders out? Is it time to bring in a credit controller to do this properly? It could be that you've taken on a larger client and you've agreed more favourable terms, but it's about understanding that. And you can do it the other way around with creditor days. So again, you can look at on your balance sheet, your suppliers. So you've bought some materials, you've received the invoice, you haven't yet paid the invoice. We can divide that by our purchases, times it by 365, which is the number of days in the year. And we've got creditor days. And we can see here, last year, on average, we were paying our suppliers within 18 days, but now we're doing it super quick and we're paying them within 8 days. So if we piece all this information we've taken from our accounts on this business, we can say that our gross profit has fallen compared to last year. So either our pricing hasn't gone up or our cost of materials is too high. Our net profit has fallen mainly because of the gross profit. We are receiving our money coming in. It's taking a lot longer to get paid from our customers, but at the same time, we're paying our suppliers a lot quicker. So that's causing a cash flow squeeze. You put all of that together and you go back to your balance sheet, that explains why we're insolvent, doesn't it? Or it goes some way to explain why we're insolvent, because our cash flow is slowing down, our profits shrinking, and it feels a little bit like perhaps we've lost control of this business. And all of that information is available just by looking at your accounts that your accountant has sent you or that you can find in your software.
Wow.
Is everybody just sitting fried now, or does any of that?
So that's incredible. I've got some questions to ask you.
Oh, you might.
And I think Amy hit the nail on the head with this. And so I am also what's the word? Not a victim. I am a victim of my own inability to know what I'm doing with my accounts, and that is Amy looks at her profit and loss once a year when we do the tax.
Yep.
So what would you recommend? So how can everybody on this call and watching back, what can everyone do to start this process? Because I've just looked back while you've been talking, I've been looking on all my stuff, but I didn't even I knew it was there, but I never really knew what it kind of meant. Now I do, which is awesome. So thank you. How often should we be doing this, and how can we tie that into our behaviors in our businesses?
So, I mean, firstly, that's really common. I think I would say the majority of small business owners fit in that category. I just look at it once a year because I just want to know what my tax figure is. And I think it does come down to a lack of education. Like, if this is the first time that you've been told this is the first time you've attended a training or webinar, then how would you possibly know? Which is why we're doing this. The best way to change it is it really, I mean, you're going to struggle to do this throughout the year if you're doing your accounts on spreadsheet. So step one is really to have a software such as Xero. And Lynette, have I got enough time just to quickly put Xero up on screen?
Yeah, we've got till 1:30, so that's
right. Cool. Okay, so I'm just going to stop the share for a second. I'm just going to open Xero up because what I've got is a lovely demo company on Xero, which I can. Oh, that's worked quite well actually. Right, I've lost my Zoom. If I share again now, that should take me right. So this is a demo company on Xero. And there's similar things, whether you've got Xero, FreeAgent or QuickBooks. Xero, in my opinion, is better. There's a lot more bells and whistles, but the other ones absolutely will do the similar thing. So this is all assuming that your bookkeeping is up to date and accurate, and that's really important. And just a side note, if you're doing your own bookkeeping, do the training that the software providers give to you to make sure you're doing it correctly, because it's garbage in, garbage out. If your bookkeeping's wrong and then you run these reports, they're going to be wrong as well. So, but Xero provides all of these lovely reports. So first off, we've got the profit and loss account, which is exactly what we've just been looking at. So this is the power of these softwares. You can every day look at your year-to-date P&L if you want to. You could look at last year, you could compare it to 2 years. I mean, there's not data in the previous years, but you can have those comparisons. You can, if you see here, you can look at previous months, financial year compared to budget. You can learn how to custom make your own reports in Xero, which is fantastic. So you can literally build in all those lovely percentages that I've just told you about. You could build these into the reports. You can run this on a year-to-date basis. So you can see where you are. What's great about these is, and especially Xero, which I really love, you can export it. So you can click the export, download it into an Excel spreadsheet, which is what I do, and then do loads of fun things, create graphs from it, add on percentages, do loads of analysis with it. And Xero provides loads of these sort of balance sheets there. That's the other one we've talked about. But actually what Xero does as well is, and a lot of the other softwares as well, but maybe not quite to the degree that Xero has, there's all these other reports in here. So if we click on reports, there's all these reports. This is all financial information that you can access about your business. The ones with the blue stars are the ones that will appear on here because they're the most commonly used. But you can put a budget into QuickBook into Xero, and then you can run reports comparing your year-to-date budget to your year-to-date actuals. You can run reports on the invoices that are unpaid and owed to you. There's a whole section here. Where's it gone? It's just somewhere down. Business performance, executive summary, pulling all this lovely information together for you to look at as a business owner. So there's so much available, literally at a flick of a button. And if it's not exactly what you need, you can custom build a report, or you can download it into Excel and manipulate it and get what you want.
Amazing, thank you. Does anyone else have any more questions? I've just hopefully been keeping track of the questions in the chat. Lots of information to take in, Emma. Thank you so much. We will be sharing the links if you want to watch it back and watch the master at her craft again one more time. That will come through. We are just in the process of launching the next webinar, which is going to be taking place very soon. So please look out for that. You will also receive a message as a previous attendee inviting you to join that. And that is specifically aimed at property owners and people that are involved in rental and things like that for the Let Property campaign, which basically gives you 90 days, Emma, isn't that right, to pay your...
Yeah, so I think what we're going to cover off is, if you are a rental property owner, how does that work? What do you need to declare? There is also something called a Let Property campaign, which is almost like an amnesty with HMRC. So there's a lot of people out there who have a rental property and didn't realise they were supposed to declare the income for all sorts of different reasons. I've been looking at one quite recently where a lady's been renting a property out for 18 years, and the estate agent told her she didn't have to declare the income, and she believed him, and then now she's got found out. So we're having to go back and declare 18 years worth of taxes. So there's a specific campaign, a process of doing that through HMRC. So we're going to cover all those aspects of rental properties.
Awesome. Well, thank you so much, Emma. Insightful and engaging and wonderful as always.
If anyone's got any questions, just please do email me as well. I can, or if you want a private chat about anything.
Awesome. Okay. Best to get you on LinkedIn or just on your
either LinkedIn, business Facebook page, or direct email me. That's fine. Or even if you look on our website, you can phone and you'll go through to my PA and she'll book you in for a meeting if you want like a dedicated time to talk.
And just to manage everyone's expectations, you are currently in the middle of a hectic year end, aren't you? So we're looking really towards February to speak to. So if there's anything urgent, let us know. But we're looking to February for more kind of rounded discussions.
Absolutely. It's January, many of you will know it's the self-assessment deadline, is HMRC self-assessment deadline. So all accountants are up the wall at the moment trying to make sure that all the self-assessment tax returns are in. So yeah, we're very focused on that. But February, my life gets much easier and I have a lot more time to look at the fun things and the advisory stuff.
And on that note, it's past, so bang on. Thank you all. I'm going to kick you all out now lovingly and say thank you for coming. And
thank you.
see you all soon. Thank you.